Recently, there's been a lot of talk about the Reserve Bank of Australia, or RBA, possibly starting to cut interest rates. During this time, the Australian stock market seems to be a bit high, and with many uncertain factors from the outside. What strategies might benefit from this? Are high-yield stocks becoming more attractive to everyone? If you have any related questions, feel free to check out this episode of our tutorial sharing. Hello everyone, I am Andy Wong. As in the past, I do not have any investment advice in this teaching sharing. However, I suggest that you remember to subscribe to our YouTube channel, like our videos, and introduce them to your friends. Friends who have paid attention to my sharing will know that I have actually been cooperating with SBS for a long time, and in 2025, I have already conducted 2 interviews with them. The content is based on the fact that high-dividend stocks are one of the most important strategies in 2025. For some of the factors that may be mentioned, or the factors of some events, you can listen to SBS's YouTube interview, and I will use some of SBS's today's interviews here. The main points of the content are here to make a more detailed teaching sharing. First of all, we will see that Australia's economic data, such as the recent CPI, that is, the inflation data, shows signs of continued slowdown, and they are slowing down faster than the market. Here is where one situation we can see is the usual RBA rate watch, which is to see how likely the market is to expect an interest rate cut. Well, the next RBA meeting is on the 17th, 10th, and 8th of February. Well, we can look down from mid-January to now, which is January 30th. We will meet. I won't make any moves until I decrease to 4.1%. That is, the situation of interest rate cuts. In fact, what proportion is? That is, the direction of interest rate cuts from 73%. Incrementally go to 95%. That is, at this time, you can create a picture for everyone to refer to. Your market. Do you expect the next interest rate cut? It has reached 90%. Could it be that it has been almost a year? Other markets have been cutting interest rates for a long time, but the RBA in Australia has finally started to officially cut interest rates. In this interest rate cut cycle, for the time being, the market has expressed its opinions and will be more aggressive than the news. For the time being, we will see that the price is around 4.35 cents. We expect it to go soon. By the end of 2025, we have reached close to about 3.5%. Of course, this is the market, and the voting is tight. It is estimated that there may be many variables. For example, we will see that even the U.S. Federal Reserve. Last year, everyone thought that the interest rate cut would reduce it a lot, but in the end, the market will slowly adapt to it. There may be some different sudden factors, some economic data, and some adjustments will be made to reduce interest rates. Suddenly, everyone does not expect to cut interest rates. Yes, you could even try it. The market is for speculation. With interest rates going up, we need to keep an eye on the gradual changes over the next few months, and we'll continue to follow up on this in our tutorial shares. Of course, there's also the possibility of something unexpected happening that could accelerate the rate cuts, and that's another point to consider. With the possibility of interest rate cuts in Australia, along with many uncertain external factors, and considering that the valuations of mining and financial stocks in the Australian stock market seem relatively high, we might want to think about whether funds will start chasing some high-yield strategies. So can high-dividend stocks be a top-tier stock? Because traditionally, many times high-dividend stocks are regarded as high-dividend stocks by some investors or funds because they will make some dividend payments. In fact, they can predict their own cash flow. This action, in fact, I have helped some clients to make some such investment plans in the past. It's estimated that I'll receive dividends each quarter, creating passive income. That's a benefit of high-yield stock. Additionally, high-yield stocks are often seen as defensive options, helping counteract market volatility. In volatile times, they provide stability. When the market fluctuates, high-yield stocks' defensive traits make them a preferred choice for funds. This is a key characteristic. Furthermore, Australian investors might focus on the franking credit, offering tax benefits. It provides stable cash flow and a tax advantage for local investors. This aspect might not be covered here, so consult your financial advisor. When the stock market is a bit choppy, high-yield stocks have their defensive qualities, which makes them an attractive choice for funds looking for a defensive yet aggressive strategy. This is one of their key traits. Additionally, Australian investors might pay even more attention to high-yield stocks because of the franking credit. This means that when investing in stocks, there are some tax benefits or arrangements involved. There will be some tax benefits or arrangements, and franking credit is among them. In addition to providing a very stable cash flow, as we mentioned above, there are also opportunities. This may give some Australian local investors some advantages or discounts when it comes to taxation. On the one hand, this is something that will not necessarily be mentioned in the teaching sharing in this episode. You can ask yourself about your preferences. Consultants or financial advisors can help you understand more about this.
Hey everyone, I'm Andy Wong. I'm one of the few people here in Australia and Hong Kong who is licensed or qualified to help local clients and companies with diversified investments, like my years of experience with US stocks, Australian stocks, SMSFs, ETFs, and so on. I hope to share my investment and life experiences with the Chinese community in Australia and Hong Kong through this YouTube channel. If you're interested in having a one-on-one chat with me, you can book a time through the link below the video or in the channel's content. Schedule a time with me.
Speaking of high-dividend stocks, it seems so attractive. How about we take a look at the performance of high-dividend stocks or ETFs called high-dividend strategies? Well, we borrowed a high-dividend stock strategy ETF listed in Australia. Among them, the index is the green line as a reference, and what we compare is the ASX 200 index that we usually hear in the news. As for the orange line, I turned it into a dividend cumulative return. Even if those dividends are paid out, they will roll over, so in fact, this is Apple too. Let's look at the performance of Apple and Apple. We will see that if we accumulate 10 years of performance, the green line outperforms the orange line by a large margin. 151% comparison. 86. This percentage is actually a snowballing effect, especially what we will see when the interest rate starts. When it stabilizes, that is, when interest rates are no longer particularly raised, will it peak or even fall back? It's more obvious that high-dividend stocks have outperformed to that extent. So, we can think about it, as mentioned at the beginning of the first program, when the RBA is preparing to cut interest rates, will there be enough funds to spend it? A strategy. When it comes to high-yield strategies, they may seem really strong, but we have to remember that they're not a perfect strategy. I believe there's no such thing as a perfect strategy in the world, because every strategy has its downside risks. Just like with high-yield strategies, they can be influenced by market sentiment. Overall, there are times when they might underperform or carry some downside risk. So, when you're investing, you need to be mentally prepared for that. But here, I'm just sharing this for educational purposes. I want to talk about a lot of blind spots about high-dividend stocks. I want to share some common things that I have seen in the investment market in the past 10 years. For example, everyone, you may have heard, I buy a stock because its interest rate is high enough, so I don't care about the factors behind it. If I hold it for a long time, I think this sentence is good, and it is quite remarkable. For example, let's take this stock as an example. Side Energy WDS is a well-known high-dividend stock in Australia. Because you can see the black line, what is its expected dividend payout rate? In fact, it happens many times. The average is about 4% or above. This one will make many investors feel how attractive it is. but we can look at it. In fact, in the past 10 years, for example, from 2018 to 20 years, or from the high level of 22 years to now, we have actually tried to fall by 60% or 40%. Don't wait. You should pay attention to this. If you are buying high-dividend stocks, are you a company of that company? The asset classes behind it are very cyclical. Just like WhatsApp Energy, it may be relatively sensitive to oil prices. If oil prices fall, there is a good chance that it will drag down the company. Its performance will have the opportunity to affect its oil price, that is, its individual stocks. This will affect the following. You may be mentally prepared during this investment period. Similarly, they may also have opportunities. Because of this, you may have business operations. Is it true that when things are done well and when things are not done well, it will affect the performance of the dividend payout? In fact, you should pay attention to it because usually long-term investors, especially institutional investors' funds, they will want to find some stability. There are so many good companies. So if you are looking for high dividend stocks, you would want to pick something like this. It is a company whose business may not be so cyclical and whose dividend payout is stable. It will be more attractive. Alright, are there any other common blind spots with high-yield stocks? A frequent one is that people might only notice when a company suddenly has a high dividend and think, I want to jump on that. But we need to be cautious about this situation because some companies might not have strong operational or financial performance. They might offer a one-time, unexpected dividend that makes it seem like their payouts are high, but in reality, they might not be sustainable. When a company offers high dividends, be cautious. Their business might not be doing well, leading to poor earnings and a stock drop. Choose carefully. WTS isn't one of those examples. It's a stock more cyclically influenced. In choosing high-yield stocks, look for quality high-yield stocks. For long-term, find companies with stable dividends. Ensure a stable payout ratio. Are the company. To summarize, when selecting high-yield stocks, focus on quality ones. Especially for long-term investment, look for companies with stable dividends and a consistent payout ratio. Ensure their finances are solid, even in cyclical industries, and that management is effective in reducing cyclicality. This stability supports healthy financial statements and consistent dividend payouts. Also, evaluate the economic environment and industry trends. If a company is in a declining industry, it may be less attractive despite high yields. Conversely, if the industry is stable, it could be a good choice. The finances need to be stable. Maybe it doesn't matter whether it has a cyclical business, but we would like it to be a relatively stable one, even in the same industry. In fact, its management is doing a good job. As a result, their periodicity will actually be relatively low. What has changed is that they may feel uncomfortable because they have healthy and stable financial statements, so they may naturally do so. Think about the dividend payout ratio and what can be done to stabilize the dividend payout. Well, the fourth point is that we actually have to make some judgments about the economic, environment, or industry characteristics. The trend during this period of time, are they benefiting from it? Even if it is a sunset industry, in fact, they are not so attractive, even if they pay high interest rates, but it is reversed. In fact, it may be that the industry as a whole is stable even. You may be able to benefit from the national policy. You may be able to see it somewhat in this situation. Point 4 is one of the things you need to pay attention to. In the SBS interview, I also mentioned a few examples of high-yield stocks for educational purposes. For instance, when thinking about high-yield strategies, you might wonder which sectors are considered high-yield sectors. Traditionally, some consumer, retail sectors, like the supermarkets we have in Australia, come to mind. Clothes and you can both be seen as relatively high-yield sectors, and one of their characteristics is that they deal with situations we encounter in our daily lives. Of course, they also have their own underlying factors. For instance, let's take a look at Close. First, you'll see that its projected dividend yield is around 3 to 4%. However, Close's stock price has actually been rising over the past year or so. Is it continuously rising? Similarly, with Woolworths, its dividend yield is lower, around 2% to 3% recently, while its stock price has been declining. These companies may seem similar, but their operations cause differences in dividend yields and stock performance. This ties back to my earlier teaching. Data from Bloomberg and major firms suggest this sector is one to watch during a rate-cutting cycle. Projected yields are around 3%. If RBA cuts rates below 3.5% next year, sector yields could become attractive. Some companies improved online operations and business capabilities after recent restructuring as a result of their dividend payout rate and the performance of their stock price. It turns out that there can be such a big difference in the same period. This is the same as what I taught above, and I have read this period. For example, there may be some data on Bloomberg or some statements from major banks. This sector may be regarded as an interest rate cutting cycle, and it may become a sector worthy of more attention. Well, that's because of their forecasted dividend rate. If the RBA cuts rates below 3.5%, the average projected dividend yield for the sector could become quite attractive, possibly around 3%. Additionally, some companies may have improved their online operations and business capabilities after restructuring in the past couple of years. This could lead to a situation where both dividends and stock prices could see positive outcomes. Within the same sector, performances can vary. Research which companies meet these conditions. Telstra, a telecommunications company, has been viewed as more stable by major firms over the past 2 years. This could create an opportunity for both dividends and stock prices to benefit simultaneously. I'm not specifically naming any stocks here, but this is an example to show you that within the same sector, there can be different performances. So you might want to do some research to find out which companies meet the conditions I mentioned earlier. Is there an example in another interview with SBS? It's Telstra. I believe everyone is familiar with it. They are a telecommunications company, right? You can pay attention to it. Hey, let me use the 2-year chart to do a tutorial first. Hey, let's take a look at this period of time. In fact, we will see that Telstra's business may have been regarded by major banks. In order to be more stable, you will see that when the stock price falls back from a relatively high level to a low level, moving toward a higher level and predicting a dividend yield will be like looking in a mirror and flipping over. When the price is high, the dividend will be lower, and when the stock price is low, the dividend will be lower, it will be higher. When you turn to the middle, the dividend rate has doubled again, and there is something in the middle. I personally regard this as one of the representatives. And the business has begun to be stable. That is to say, let's talk about them. Dividends have also begun to stabilize. So what? Actually, this is one of the examples I mentioned earlier, and it could be a way to filter stocks. Why am I focusing on these 2 years? Because if you look back even further, say 10 years, you might see that there was a time when Tesla's stock performance wasn't very good. The trend of its dividend yield during that period was somewhat proportional to the decline in its stock price, especially compared to the last 2 years. The reason is that we all may have some different business factors that are being adjusted at that time. So when Echo turns around, the first thing I will talk about is if he picks a high quality, high dividend stock, one of them, we all need to take a look. After all, the company itself is relatively stable and it may have already started and you have already seen some prospects. What happens easily is that while you are watching the company grow, this dividend is possible. Is there going to be a more stable situation? In the first teaching sharing, in addition to telling you some key points of some high interest strategies, we are also following some examples from the SBS interview to make a recap for everyone. I know, of course, there are actually many high dividend stocks that are different from other stocks, and there are also many high dividend stocks that require a lot of homework. If you have any questions or are interested, you can leave a message and let me know. Listen, I might be interviewed by some other media or In today's teaching session, I want to follow up with everyone. Similarly, I hope that before you make any investments, you remember to consult with professional investors to discuss relevant topics. This way, you can figure out how to create an investment portfolio that suits you, and you might even achieve a passive investment effect within that portfolio. All right, that's it for today. That's it for sharing. If you support our wish, we hope to continue to introduce more friends to subscribe to our channel. Thanks for sharing.
Thanks for your support. Remember to leave a comment, give a thumbs up, and share. Our teaching share doesn't include any investment advice. So, before you make any decisions, remember to consult the relevant licensed professionals for advice. Thanks a lot.